Public markets operate on the fundamental assumption that everyday investors can trust financial disclosures to allocate their capital safely. To maintain this trust, the system relies on external auditors, licensed accountants who verify corporate filings and act as independent watchdogs. Before 2002, this structure contained a structural paradox. The watchdogs were financially dependent on the exact management teams they were evaluating. Corporate management possessed the unilateral power to hire, pay, and fire their own external auditors. When the people being graded pay the graders, financial incentives naturally align to obscure bad news. In this system, catastrophic fraud becomes predictable. In 2002, Congress enacted the Sarbanes-Oxley Act as a systemic intervention to fix this broken incentive loop. The legislation functions as a complete architectural rebuild of United States corporate disclosures. This new architecture rests on three pillars: establishing federal oversight, severing financial conflicts of interest, and mandating personal executive liability. To understand modern corporate finance, one must examine how Sarbanes-Oxley restructured the flows of money and liability inside a public company. The new structure places a dominant authority at the top of the hierarchy. Title I of the Act established the Public Company Accounting Oversight Board, or PCAOB. This provision removed the accounting profession's century-old ability to regulate itself. While it is an independent, non-profit corporation rather than a government agency, the PCAOB operates under the direct oversight of the Securities and Exchange Commission. Sections 104 and 105 grant the board the unilateral power to inspect registered public accounting firms. The board has the legal authority to demand audit work papers and compel testimony from any person associated with a public accounting firm. If the board discovers non-compliance or fraud, it can impose multi-million-dollar civil penalties and permanently revoke a firm's registration. The PCAOB serves as an apex authority in the auditing ecosystem, ensuring that the auditors themselves are overseen by an entity they do not control. The Act also fundamentally changes the financial relationship between the external accounting firm and the public corporation it audits. Historically, auditing firms often generated higher revenues from selling lucrative consulting services to their clients than from the audits themselves. Section 201 was designed to block this specific revenue loop. It explicitly bans a firm from providing certain consulting services to a client while simultaneously performing their audit, including bookkeeping, financial information systems design, and internal audit outsourcing. This prevents a clear conflict of interest. An auditor cannot objectively evaluate a financial system that their own firm was paid to design and install. To address the human element of institutional bias, Section 203 introduces audit partner rotation. This creates a statutory requirement. The lead audit partner must rotate off a client's account every 5 years, preventing long-term personal relationships from compromising professional skepticism. Title II eliminated the primary mechanism of auditor corruption by forcing accounting firms to choose a single role, auditor or consultant. Even with consulting fees removed, corporate management still held the power to hire and fire the auditors. Section 301 rewires the hierarchy, elevating the audit committee as a structural buffer. Every member must be on the board and strictly independent, accepting no consulting fees. This committee is now solely responsible for hiring, paying, and overseeing the external auditing firm. Because the auditor now reports directly to the committee, the CEO and CFO are removed from the direct oversight loop. Section 301 functions as a structural firewall, ensuring the executives preparing the financial data have no leverage over the professionals verifying it. Finally, the Act focuses on the executives responsible for generating corporate data, the CEO and CFO. Before these reforms, executives could claim they were unaware of accounting fraud occurring under their leadership. Section 302 ended this defense by requiring principal executive officers to personally certify the accuracy of quarterly and annual reports. This sworn statement demonstrates the legal gravity of that requirement. By signing, the CEO guarantees they have established internal controls, evaluated their effectiveness within the last 90 days, and disclosed any material weaknesses or fraud to the auditors. To deter misconduct, Section 304 attaches personal financial risk to these certifications. This is triggered if a company issues an accounting restatement due to misconduct. Under Section 304, the CEO and CFO must reimburse the company for any bonuses or incentive-based compensation received in the 12 months following the fraudulent filing. Sections 302 and 304 align executive interests with accurate reporting, ensuring that if the financial statements are fraudulent, the executives are personally liable. This completed model shows the interlocking layers of defense mandated by the Sarbanes-Oxley Act. If management attempts to manipulate data, they face the personal financial penalties of Section 304. If they attempt to pressure the auditors, they are blocked by the independent buffer of the Audit Committee. If the auditors neglect their duties, they face mandatory partner rotation and federal oversight from the PCAOB. This structure replaced a system based on professional trust with an overlapping framework of statutory consequences. The true legacy of the Sarbanes-Oxley Act is the recognition that corporate accountability requires specific, engineered legal constraints.